If you have been told that you need to start investing in stocks and you are confused as to which stocks to buy, or you have watched stock breakdown on YouTube and you just wonder, where do these people get their information from? Well, I will be showing you exactly how to choose and analyze your own stocks as a beginner. Hi guys, welcome back. At the end of this video, you will have clear, actionable steps that you can take today to start choosing and analyzing your own stocks. Let's get started. The first thing you need to do is to decide what you want to invest in. You could invest in individual stocks, you could invest in mutual funds, or you could put your money in ETFs or index funds like the S&P 500. The general recommendation for beginners is to put all of their money in a broad market ETF or index fund because it provides, automatic diversification and a guarantee for potential return in the next 20 years. But if you clicked on this video, you are probably not looking for the safer option. You want to pick your own stocks. So the next step is to choose the type of stocks you want to invest in. So stocks are categorized mainly into three. You have dividend stocks, growth stocks, and value stocks. Dividend stock are the type of stocks that pay you dividend income, usually every quarter based on the number of shares that you own. This dividend can be seen as passive income or can be reinvested into the companies that you currently own, thereby helping you grow your investment portfolio. A classic book to read for dividend investing is The Single Best Investor by Lowell Miller. This book is written in a simple, easy to understand form, and all you have to do is to pay attention. And I understand that it might not appeal to more hardcore or more financial analysis based people. The next type of stocks you'd be interested in would be value stock. So value investing is looking for stocks to buy at a discount. This type of investing was espoused by truly great investors like Charlie Munger, Benjamin Graham, and Warren Buffett. The premise behind this type of investing is simple. In the short term, a company can become undervalued due to short-term fear around that stock, leading to investors selling most of their stocks and the stock being undervalued. Take for instance, when Chipotle had the food crisis some years ago, their stock price tanked. However, the company fundamentals remained the same. So their brand value, the customer base. Eventually, the stock price grew. A great read for value investing is The Intelligent Investor by Benjamin Graham. Another podcast you can listen to is called Invested. It is by a hedge fund manager, Phil, and his daughter, Danielle. Basically, Phil explaining investing to his daughter. The other type of stocks that you have are growth stocks. So growth stocks are companies that grow at a faster rate in terms of revenue and sales compared to the overall market. Companies that are usually growth stocks fall under industries like innovation, technology, and healthcare. Growth stocks are available for you to look into as someone who is thinking of rapid growth for your portfolio. So if a company currently earns $100 per share and in the next 10 years they are projected to grow at about 10%, after a few years that stock would be worth much more. Even though it might appear like you did purchase the stock at an expensive price today, it will be worth much more in the nearest future. So you are investing in future value and not the present value. There are other types of investing that you can consider. You have day trading, technical analysis, but those require more in-depth knowledge and most beginners don't have the tools for that. Now, the next thing for you to do is to come up with your company watch list. This is where the hard work begins. I usually advise people to start with 5 to 10 companies. You could do this by looking up companies that you already use their products, and chances are that if you like a product, other people like it too and they're using it. Listening to YouTube channels that analyze fundamentals, or reading up finance news on platforms like Bloomberg, Wall Street Journal, or Yahoo Finance. Starting and having a company watch list helps you to have a little bit of focus. Now, the next step for you to take would be understanding the company fundamentals. Here, your focus is to look into what the company currently does and what they are projected to do, not what their stock price is doing. You are looking at what they do, their main source of revenue, and who their competitors are. Next, you need to take a step outward and look at the overall industry in which your company is playing. It is usually said that stock prices are based on the industry and not the overall market. In looking at the industry that your company is, are they a disruptor or are they a leader? You want to have an honest conversation with yourself. Are they lagging or are they leading? Next, you want to understand and look up their reports. So you can start with the 10Q report. The 10Q report is a report that is filed quarterly by public companies in the United States with the United States Security Exchange Commissions. The 10Q, you can find it on the SEC's website. It's usually in the Edgar database. The 10K, on the other hand, is the annual version of the 10Q. So the 10Q is the quarterly report and the 10K is the annual report. You want to skip all the accounting details, accounting information, and go to the management discussion and analysis part of that report. You can also find the 10K and 10Q in the investor tab of the company that you're looking up. Finally, you want to check or listen to their earnings call. This is a step that's very, very important, yet many investors skip it. You can find the earnings call also in the investor tab of the company. The earnings call is usually done every quarter by almost every company, and they provide you with information regarding their financial situation and answer questions from investors and shareholders. The earnings call can also be found on Google. You can just Google the transcript and just read it if you do not want to listen to the entire call. The earnings call helps you to understand management's, confidence around their priorities, their strategy, their opportunities, and the risk that they foresee. So do not skip that. The next step is to look up and understand the stock price volatility. Note that this is the first time that the stock price is coming into play. The stock price volatility, also known as beta, refers to how volatile the stock price is, because how often the stock price undergoes changes. So a beta less than 1 indicates that the stock price is stable, and a beta greater than 1 shows that it is very volatile. If you're a dividend investor looking for something more stable, you'd be looking up companies with betas less than 1. And if you are a growth investor, you would be considering companies with betas higher than 1. Next, we need to come up with our SWOT analysis. SWOT simply stands for strengths, weaknesses, opportunities, and threats. What competitive advantage does your company have? That's the strength of that company. The weakness refers to the vulnerabilities that they have that other companies can exploit. The opportunities are the opportunities around them that they can potentially leverage. And the threat refers to external factors that can hurt them, including regulations. The SWOT analysis is very helpful because it gives you an idea of the upsides and the downsides that your company has before committing your money into that company. Next, you want to come up with your company thesis. The company thesis is simply your own principle or definition around why you are investing in this company and what would have to change for you to stop investing. Take, for example, you want to invest in Verizon. You might want to say something like, I am buying Verizon because it pays a dividend of 7%, they are low in debt, and they are well positioned for 5G technology, which is an area that most consumers and customers are interested in. I will reconsider my position if Verizon begins to pay a lower dividend or if other companies outcompete them in 5G technology. The company thesis helps you to keep your decisions logical and not emotional. By the way, the example with Verizon was completely hypothetical, nothing that I Googled or researched. So with that, we've come to the end of the major steps, but here are some additional tips. 1, don't get caught up in action paralysis. You have done all of this work. It's time to start investing. You could start with $50 or $100 just to get your skin in the game. Know that the more invested you are, the faster you will learn. You are not done when you invest. You need to keep researching. Investing is not a one-time thing. You need to keep learning. You need to keep refining your decision. Don't stop looking up your companies, reading and learning about them, listening to their earnings calls and reading up reports. With that, we have come to the end of this video. Like, because it does help this channel a ton, and subscribe to keep getting beginner friendly content like this. Know that it is not the timing of the market that matters, but your time in the market. Hope to see you next time. See you again, guys. Bye.
The Lord bless you and keep you. The Lord make his face shine on you and be gracious to you. The Lord turn his face toward you and give you peace.